Welcome. In this video, we're going to talk about liquidity containment candles. All right. So without further ado, let's get started. All right. So before I begin, I would like to recommend everyone watching this basically start taking notes on this topic because it is an advanced topic for most of the traders out here. Okay. If you're a new trader, then you definitely need to take notes on this because you will require a lot of practice in order to basically start trading with the liquidity containment candle setups. Okay, so get your notepads ready, grab a pen and a paper, start taking notes on this because it will help you in your day-to-day trading. All right, so first we're going to start off with the basics of a liquidity containment candle. All right, so let's start with the first point over here. A liquidity containment candle is simply a candle with a high or a low contained in the previous candle. All right. So unlike we talked about the liquidity, unlike we talked about the containment candle itself, where the high and the low is contained in the previous one, liquidity candle is basically a candle where a high or only a low is contained in the previous candle, depending on the type of trend we have. Okay. Next point over here. Both high and low will not be contained in the previous candle. All right. So like I mentioned before, if you are looking for a bullish liquidity containment candle, then the high will be contained. Or if you're looking for a bearish liquidity containment candle, then the low will be contained. All right. Now, just to clarify and make this a little bit more easier for you all, what I will do is basically draw a series of candles over here to illustrate the example. So let's start up with the bullish. Okay. So let's talk about bullish liquidity containment candle. All right. So what you can expect in this type of setup is basically this. So what will happen is that price will be trending bullish or bearish. Okay. So let's just say you had a bearish trend coming down. Okay. Price was coming down, making lower highs and lower lows. Okay. Until you saw some sort of a rejection happening. Okay. And candle end up closing like this. Okay. So a candle here looks like we are rejecting to the downside and also forming support, plus we have a rejection wick. Okay. So if the next candle basically goes down, breaks the low of the previous one, but ends up closing bullish, okay, without breaking the high of the previous one, okay, then this is going to be contained, this is going to be called a liquidity containment candle. All right. So what we are seeing here is that the high of the previous candle is not broken, right? But what's happening here is the low is broken. So it's not perfectly contained, but the highs are contained here. So what are you going to expect the next candle to do in this type of market structure is to basically continue going bullish. Okay, so what is going to happen is the next candle will create a lower, higher low. And once it breaks the high of the previous one, we're going to continue going bullish. And this is going to be your trading candle. All right, this is where you're going to execute your trades. Your stops will be placed below the liquidity candle. All right, right over here. Entries will be once the next candle breaks the high, and look for the next area of rejection to secure the profits. So once again, this is going to be your stop loss. All right, this is where your entry will be, and this is where your take profit will be placed. All right. Basically, the nearest area of rejection is going to be your take profit area entries, and this is going to be your stop loss. All right. Now, in bearish, if you're looking for a bearish type of containment candle, then what you need to see is basically possibly price going up, right? possibly rejecting, coming down, right? Now, if you're looking at this, looks like as the candles are coming down, we are getting smaller and smaller in size, okay? But if the next candle starts breaking the high of the previous one, right, it might seem like we're going to continue going bullish, but what ends up happening is that the candle ends up closing like this. It breaks the high of the previous one, but it ends up closing like this, right? Now, what happened here is that we broke the high of the previous one, right? But the lows are contained, which we're talking about in a bearish liquidity containment candle. Okay, so once you see this type of price formation, what you can expect is the next candle to start breaking the low of the previous one, and we could have a further continuation coming down to the next area of rejection. Okay, your stop loss will obviously be placed above the previous candle. Entries will be taken once the next candle breaks the low of the previous one, and take profit will be the next area of rejection. So this is where the stop loss will be. This is where the entries will be, and take profit will be basically the next area of rejection, right? Also, it will be your next area of support. Okay, so this is the type of market structure you can basically anticipate to have in order to trade a liquidity containment candle, right? Especially if you're looking into a bearish liquidity candle. All right. Moving on, let's move on to the third point over here. Liquidity containment candle usually appears after a retest of the zone broken and at a major area of rejection. All right, so these are the two possibilities that you could possibly have that will basically lead you to have a liquidity containment candle. Okay, so first is basically retest of a broken zone and a major area of rejection. So make sure you take notes on this. All right. Retest of a broken zone and at a major area of rejection. Okay, so the past two examples we did based on the bullish liquidity containment candle and a bearish liquidity containment candle was based off a major area of rejection. Okay, we haven't done an example of retest of a broken zone. So let's do an example of a retest of a broken zone. All right, so let's say price was trending originally bullish, okay, making higher highs and higher lows. And then what ended up happening is that price started consolidating, okay? Price started consolidating until we had a further break to the upside, okay? So once we had a further break to the upside, we continued going bullish, okay? And then what ended up happening after this is that we start ranging again, which is consolidation, okay? So in this type of example, right? Now this happens very often in the market structure, which I'm drawing right now, okay? So let's mark up our support and resistance, which we can see in this example, all right? Let's grab a yellow color here. So we have a resistance turn support because we broke above this area, okay? So let's mark this up as our area of support. So we have a support level right over here, okay? So what you can anticipate price to do in order to become a liquidity containment candle is something like this. In this area, what you will possibly see is a retest of a major area broken, okay? So let's say price does come down, okay? And we have a candle closing bullish, Okay. Now, if price does break below the consolidation like this, so this candle, bullish candle here, seems like we're just doing some sort of retest. And once the next candle closes bearish, okay, there could be a further continuation to the downside. Okay, now that happens very often too. But if you do see something like this, which I'm going to draw right now, something like this, which happens a lot of times as well, this is going to be called a liquidity containment candle. Okay, so we broke below the consolidation, we came down, did a retest of this resistance turned support. Okay, because coming up, we had resistance encounter from here, but once we broke above this area, now this is going to be a support level, a resistance turned support. So now what we're focusing on the most recent market structure, which is given over here. Okay, so this area. So if the next one also end up closing bullish instead of closing bearish, now what you need to see is the highs and the lows. So if you're looking at this area, would we know that the low of the previous one is broken, the high of the previous one is contained? Okay, the current candle did not break the high of the previous one. So if that happens, what you need to see is basically the next candle to respect the low of the previous candle and basically start trending bullish. Okay. So what end up happening here is that we did a retest of a broken zone. So this is a zone. This is an area of rejection. We broke above, start consolidating, came down, grabbed liquidity, right? With the liquidity containment candle right over here. We tapped into that zone. That means we basically did a retest of the zone broken, and a candle closed like a liquidity containment candle, and the next candle can basically continue going bullish. Okay. So this type of market structure could be something that you can look into when it appears in your day-to-day trading. Okay. So moving on to the next point over here. A liquidity containment candle is a very powerful trend continuation candlestick pattern, which can appear in any time frame after a period of consolidation or trend. Okay, so talking about the time frames over here, it could happen in any time frame. Okay, it could be happening on a 5-minute time frame, 15-minute time frame, 30-minute time frame, or even something like a daily time frame, which is considered a higher time frame. Okay, so unlike the containment candle itself, a liquidity containment candle is also a powerful candlestick formation. But what the major difference is basically a trend continuation. Okay, so once the trend is bullish, right, and we enter in consolidation, right, price breaks above this area, comes down, right, grabs liquidity, and basically continues going bullish, right? So this is basically where you're going to encounter a liquidity containment candle. But what we need to see is that this is a major trend continuation. And the trend here is basically, as you can see, is bullish. All right. So this is your bullish trend continuation. All right. So simple as that. All right. So let's move on to our next slide over here. Now we're going to talk about some of the most advanced stuff about liquidity containment candles. And first off, we're going to start off with the bullish liquidity containment candles. So like I said before, have your notepads ready, grab a pen and a paper and start taking notes on this, because this is something that happens very often in any financial markets. So it's really important for you to understand this concept. So whenever it happens next time into your session when you're trading, and if you have the knowledge of this, you're going to be able to see the opportunity. All right. So let's say the opportunity is happening, but you do not recognize the opportunity. If you do not recognize the opportunity, you're never going to be able to execute on that certain opportunity. In order to fully understand the opportunity and in order to fully execute on that opportunity, you need to have a clear understanding of the opportunity which is being presented to you. And how are you going to do that? You're going to do that by starting writing down the notes, attaining knowledge, practicing it in your day-to-day trading, and it will take you to a point where you're going to be able to execute on setups like this every time it appears on your chart and have a very profitable trading session. So we're going to get started with this right away. Okay, so make sure you're taking notes on this. All right, so the first point over here is basically the body of the liquidity containment candle should be bigger, longer than the upper wick. Okay, verifying this will increase the probability of the next candle respecting the low of the previous candle, which is your liquidity containment candle. And this is where the stop loss will be placed. Okay, so what I mean by this is basically is this. So we have a candle right over here. Okay. The next candle will be something like this, where the high will be contained, but most likely the low will be broken. Okay. So what you need to verify is basically the highs are contained if you're looking for a bullish containment candle. Okay. The low is broken, and we also have grab liquidity. Okay. So when I talk about liquidities, this is the liquidity grab here, right here. Right. This is a liquidity grab. Basically, this is where the investors, hedge funds, bigger institutions grab the price and start moving back up. Okay. For retail traders, our confirmation to take a trade will be basically this candle closing bullish itself, obviously. The next one will be basically respecting the low of the previous one. Okay. And once it started breaking the high of the previous one, which is your liquidity containment candle, we're going to have a move going bullish. Okay, so key things you need to verify: the lows and the highs. Make sure the highs are contained, make sure the lows are broken. Okay, in a bullish containment candle, sorry, liquidity bullish containment candle. All right, and once the highs are broken, you can have a profitable trade going up. Okay, so this could happen at a major area of rejection. This could also happen by retesting a major zone broken and looking to the left hand side. Okay, you might have a market structure on this side right over here. Okay, and we possibly doing a retest to have a further push to the upside. Okay, now talking about the stop losses. Okay, so let's draw the candles one more time here. We had a candle here. The next one was your liquidity containment candle. Okay, so where your stop loss is going to be? Your stop loss is going to be basically below the liquidity containment candle, like we talked about. So let's put the stop loss right over here. Stop loss will be right here. Let me just increase the size of the fonts here so you can see it better. All right, so stop loss will be right over here. All right, entries will be taken once the next candle starts breaking the high of the previous one, which is right over here. So that's going to be your entry. Okay, so you're anticipating the next candle to continue going bullish. Let me just grab a better color. Okay, we're going bullish. And take profit will basically be the nearest area of rejection. Okay, whichever is the nearest area of rejection on your Pacific chart. Okay, so that's going to be your TP. TP stands for your take profit. All right. Moving on to the second point over here. In order for liquidity containment candle to work in an uptrend, the next candle must respect the low of the previous bullish liquidity containment candle and break the high to confirm further bullish trend continuation. Okay, just like we talked about. Let's have the drawing on the right hand side over here so we can keep referring back to it. Okay. So let's put this point into example over here. So the next candle must respect the low of the previous one. All right. What I mean by that is the next candle is going to be a trading candle. It should create a higher low. And once it start going bullish, this is where you're going to be looking into securing your profits. So we have a low of a containment candle liquidity containment candle, which is right over here. All right. Obviously, it has broken the low of the previous one before that, which is fine. Okay. But what we need to see is the next candle have a higher low. Okay. So that's basically what I mean by next candle must respect the low of the previous bullish liquidity containment candle. All right. So this is your bullish liquidity containment candle. So let's just type this down right over here. Bullish liquidity containment candle. And change the color to yellow. Perfect. All right. And this is your next candle basically. Okay. Which is also going to be your entry candle. All right. Make sure you're taking notes on this. Okay. And further moving on, once the next candle break the high of the previous one, which is your bullish liquidity containment candle, is going to be considered your previous one, you can have a bullish trend continuation going to the upside. All right. Moving on to the next point over here. Once a trade is executed, look for next area of rejection. And as you're moving to the upside, you're going to be looking for resistance areas or a potential target to secure your profits. All right. So simple as that. Really simple concept, very simple concept. Just need to have a clear understanding of how the structure forms and how it works. And as long as you follow the principles of this type of market structure, you're going to be able to have a very profitable trade. Okay. Now, the tip for this type of topic is basically trade should only be executed after the break of the high. Okay. It is very important though. Okay. So let's clear up some space and show you what I mean by that. All right. So the tip here is basically breaking the high of the previous one. Okay. So if this candle does not break the high of the previous one and starts trending down, basically the liquidity containment candle did not activate and did not work. Okay. So it is really important for you to understand that the tradable candle, the entry candle, needs to break the high. So your best bet will be, and especially if you are a conservative trader, a disciplined trader, I would highly recommend you to basically wait for this candle right over here to break the high of the previous one. Then you can possibly take your entries. So your entries will be just like that. Okay, right over here. This is where you're going to be your entry. If you take a trade like that, if you execute a trade like that, I can guarantee you 1,000% that this trade will work for you. Okay. Okay. If you execute a trade like this, there's 1,000% guarantee, 1,000% certainty that this trade will work for you as long as you follow the principles of this type of market structure. All right. So moving on to the next topic over here. So now we're going to talk about liquidity containment candle, which is going to be the bearish one. Okay. Well, this should have been liquidity instead of liquid. All right. Let's start with our first topic over here. So the body of the liquidity containment candle should be bigger, longer than the lower wick, unlike the bearish one, unlike the bullish one. Okay. So we had a bearish candle. Let's draw some examples here. We had a bearish candle right over here. Okay. The next candle is also bearish. All right. But the low is perfectly contained. Okay. So what you need to see is basically the highs are broken, which is fine because we grab the liquidity right here. Okay. This is a massive liquidity grab. But what you need to check is basically, are the lows broken though? If the lows are not broken, if the previous low here is not broken, then you have, my friend, a liquidity containment candle. Okay. So once you see that, you're going to be able to execute on the next candle once it breaks the low of the previous one, and you're going to have a very profitable trade coming down to the next area of rejection. All right. So going back to the point over here, verifying this will increase the probability of the next candle respecting the high of the previous candle, which is your liquidity containment candle, and this is where your stop loss will be placed. Okay, so let's put it where the stop loss will be placed. Okay, so again, your stop loss is going to be on the previous candle, which is your liquidity containment candle. So let's mark this up as our stop loss. All right, your entries will be executed once the next candle breaks the low of the previous one, which means breaking the low of the liquidity containment candle. All right, so this is going to be your entry. Take profit will be the next area or the upcoming nearest area of rejection, which is going to be your support level since we're trading bearish liquidity containment candle. So this is going to be your take profit. All right. Stop losses will be right here, entries, and your take profit. Moving on to the next point. In order for liquidity containment candle to work in a downtrend, the next candle must respect the high of the previous bearish liquidity containment candle and break the low to confirm further bearish trend continuation. All right, just like the bullish one, right? It must respect the high of the previous one. Okay, price, this candle here did not come up to break the high of the previous one. Okay, so that's perfect. Let's check mark that. Highs are respected, right? What do you need to see is that, are we going to break the low of the previous one? Because if this candle here does not break the low of the previous one, it could basically reverse back up too, okay? So it is really important for you to see if you're going to break the low of the previous one. All right, so once the lows are broken, which gives you a confirmation for a further continuation to the downside to the next area of rejection, which you will securing the profits at, okay? And another thing I really want to mention is basically, so let's just say, looking on the left-hand side, okay? If you see clean candles on the left-hand side previously, like a previous market structure, which is also clean, there's a very high probability that price will mirror the move to the left-hand side. All right, if you had clean candles coming down or going up, looking left, then there's a very high probability that price will mirror the move to the left-hand side. So always keep your candlestick traffic on the left-hand side in check as well. All right, it is very important. Moving on to the next point over here. Once a trade is executed, look for the next area of rejection, also known as your support level, for a potential target to secure your profits. Okay, just like we mentioned in the example right over here. And the tip for this example is basically trade should only be executed after the break of the low. All right, which is right over here. So let me just get this as clear as possible. This is the most important topic here because managing risk is really important. Okay, like profits can, accumulate over time, but what you need to really keep in check is your risk. Make sure you're always keeping your risk in check. Make sure you're not losing than you're supposed to be. Okay, this is the only way you can last in the markets and have a profitable journey. All right, so let's draw those bullish bearish candles once again. So we have a bearish liquidity candle. All right, so what you want to see is basically the next candle breaking the low of the previous one. Then you can have a continuation down, right? So let's say if the next candle does not break the low of the previous one, instead we have another higher low and the next candle basically goes up like that, then my friend, what ended up happening here is that this liquidity candle did not activate. All right, now there are several reasons for this. One of the major reasons for this could be basically you are at a very, very strong support level. Okay, so this is a major area of rejection, okay, also known as your support level. Now, these type of major rejection areas could be on your higher time frames, okay? So higher time frames. Now, higher time frames will be basically your daily time frame, weekly time frame, okay? So these are the points you need to keep in check as well. There's a reason for everything that market does, okay? Especially the price. So if this candle did not break the low of the previous one, right, and did not activate the liquidity containment candle to work, the reason for that is basically you are at a major area of rejection, right? A support level, especially on the higher time frames, like a daily time frame or a weekly time frame. So as I mentioned before, as you go up in time frames from, let's say, 1 hour to 4 hour time frame, the support level and areas of rejection get stronger. As you move on from 4 hour time frame to daily time frame and weekly time frame, your support level gets stronger respectively. So the higher the time frame, the stronger the area of rejection. Okay, so always keep that in mind. Always follow the principles. If the next candle did not break the low of the previous one, do not blindly enter this trade, okay? Because this could turn into a very hectic trade and you could possibly have a major loss, okay? But since we talked about a lot risk management in this course, so even in that situation, you're going to be able to, keep your risk in check and lose less than you were supposed to lose, right? Let's say you opened 2% of your account trade over here. If you know how to manage your risk, okay, you could possibly lose, instead of losing 1% or 2%, you could possibly lose, 0.5% of your account. So in this course, we talked about a lot of risk management as well. So make sure you're keeping your risk in check at all times as well. So you last in the markets as long as possible and stay as profitable as long as possible and enjoy the withdrawals as much as possible as well. Okay. All right. So before I end this presentation, I would like you to look at an example which I took from TradingView. So this is basically a gold chart, all right, on a daily time frame. So we're looking at gold at a daily time frame here. So let's analyze this type of market structure here, okay? So looking here, we have some sort of a support level, which we broke above and closed right back inside, right over here. So basically what we're doing is basically we're trending bearish here. We have a high, we have a lower high, we have a lower high. Lower lows in the session, lower lows in a market trend. Okay. So what you can basically see is that we have some sort of a channel here as well. All right. So basically every time price will tap into this area, it will start rejecting. Okay. We can see that clearly. Okay. It is really simple to see things like this. Okay. So since we're talking about liquidity containment candle, I want to basically you to focus on this area right over here. Okay, so since this is a daily time frame and daily time frame support levels are very strong, what you need to see is that are we going to reject at this area? So it looks like we are indeed rejecting in this area. You see how this candle here closed a weak bullish candle, but end up still closing like a bullish candle. The next candle basically respects the high of that previous bullish candle and basically grabs liquidity from the bottom, breaks the lows of the previous one, and basically, the next candles goes bullish. Okay, so basically what is end up happening here is basically we have some sort of a market structure developing here, right? So break above and basically continuation to the upside. And this looks like a basically symmetrical triangle as well. Okay, so situations like this can appear on a chart, and basically if you recognize a liquidity containment candle, then you could possibly catch trades just like this. Okay, now this is on a daily time frame on gold. You're looking to see at least like 200 to basically 300 hit movement on a daily time frame, which is actually pretty big for gold. Okay, so if you know the opportunity and if you recognize the opportunity, you can basically execute on the opportunity and being able to secure a lot of profits. All right, so learn, start practicing, and basically start executing this type of setups, and you're going to be able to basically have a very successful journey in Forex. All right, so with this, I'm going to sign off and I'll see you in the next video.